Risk tolerance tests are often one of the first tools people encounter when they start investing. But many investors misunderstand what these results truly represent. So let's break it down in a simple and practical way. A risk tolerance test is usually a short questionnaire that asks about your age, income, financial goals, time horizon, and how you would emotionally react if your investments went up or down. Based on your answers, the test places you into a category such as conservative, balanced, or aggressive, which is meant to guide how your money should be invested. A conservative result typically means the test believes you prefer stability over growth, suggesting a higher allocation to cash or low-risk assets. While an aggressive result implies you can tolerate large market swings in exchange for potentially higher long-term returns. However, what many people don't realize is that these tests measure behavior and comfort, not intelligence, skill, or future performance. Your result is not a prediction of how successful you will be as an investor, and it is not a permanent label that defines your financial future. One of the biggest misunderstandings is thinking that a higher risk score automatically means better returns, when in reality, higher risk simply means larger ups and downs along the way. Risk tolerance tests also cannot fully capture how you will feel during a real market crash, because answering a question on a screen is very different from watching your own money drop in value during a period of panic. This is why many investors believe they have a high risk tolerance until markets fall sharply, at which point fear takes over and poor decisions like panic selling are made. Another important point is that risk tolerance is not the same as risk capacity. Risk capacity refers to how much risk you can afford to take based on your financial situation, such as your income stability, emergency savings, debts, and time until you need the money. For example, a young investor with a stable income and a long time horizon may have high risk capacity, even if their emotional tolerance for volatility is moderate, while someone nearing retirement may feel comfortable with risk but cannot afford large losses. Risk tolerance tests often mix these ideas together, which can make the results misleading if taken at face value. Your results should be seen as a starting point, not a final decision. They are most useful when combined with common sense, self-reflection, and a clear understanding of your goals. If a test labels you as conservative, it does not mean you should avoid investing in growth assets completely. It may simply mean you need a portfolio that balances growth with stability so you can stay invested during tough periods. Similarly, an aggressive result does not mean you should take maximum risk without a plan. It means you must be prepared for volatility and committed to long-term